and welcome back to another video. In today's episode, we're going to be looking at 3 stocks that I am potentially going to pick up. Okay, so just to give you a quick portfolio update, as you can see on the screen, you probably can't because my camera's hiding it. The portfolio is down £130 this week, roughly 2.4%, mainly due to Tesla, I believe, which dipped below 100%. For me, which is a shame, but most of these companies I want to keep investing in, so it'd be good to average down or average up in some cases into all of these companies, which I think are great. Okay, so the first stock we're going to look at today is a company called Sports Radar Group, which trades on the NASDAQ. This company sells sports data. It has 3 or 4 businesses which I will have a look at, or business segments I should say, when we have a look at their last report. They are reporting earnings, I believe, on the 19th of next month, so you've got 3 weeks to have a look at this one before earnings, maybe invest before earnings, we'll see, I'm not sure just yet. But if we take a look at this one, you can see there was a bit of a down period here, October and July of 2023, but things have been ticking along nicely ever since. If we come down here, you can see this is a nice way of visualizing it. We can see that revenue is growing, 27% CAGR over the last year, which is amazing, which kind of justifies the valuation. If I have a look at it over here, we can see that it's currently trading at 104 PE ratio, which is, pretty expensive. You'd expect a company like with that PE ratio to be putting up numbers in the 20s or 30s for revenue growth. But if we have a look at the more valuation metrics, you can actually see that annualized over 2020, from 2020 to 2023, the PE ratio has shrunk significantly, which is in the right direction, I suppose. Maybe, it could be getting cheaper. You would be pretty upset if you bought it in 2020. Let me have a look at the price back then. Yeah, basically it's gone sideways for a long time, and typical when I start looking at it, it's gone to the moon. So this is the slide deck or the presentation for their Q3 results. It's a really good read. Record Q3 revenue, 27% year over year, growth of 30%, adjusted EBITDA. It's a great business. It has big contracts with, big sporting events, FIFA, the Olympics, UEFA, so for your Americans, NHL, MLB. And this is an interesting slide. So they're basically showing how long they've got left on their contracts, which it's a double-edged sword. If I'm looking at that, I'm thinking if these guys are the leaders, they kind of want shorter-term contracts so that they can, change their pricing and sort of grow revenue more quickly, or even go to a subscription sort of basis. It's not my business, but I don't know, I feel like long-term contracts, especially with the way that the market's evolving with AI and integration and all these different sort of tech things, that having long contracts may not sort of allow you to leverage those sort of innovations. But, they still seem to be growing at a crazy pace. So if we look at this, page 4 of the presentation, revenue up 27%, adjusted EBITDA up 30%, and year-to-date free cash flow up 140%. So if we visualize that down here, we can see the free cash flow is just sort of, up and to the right, which is exactly what you want to see. Keeps growing that, then, it justifies the high PE. And, great margins on this one as well, 73%. And I'm not sure how much they've sort of leveraged AI and evolving technologies yet, but I still think there's room to grow for this one. So if we go a step further and have a look at free cash flow for 2024, we can see it's grown rapidly. I mean, even if they put 70 million free cash flow in Q4, that will put them at 200 million for the year. And if we work out their free cash flow yield, so 200 million for the year, 6.3 billion currently market cap, That gives us a free cash flow yield of 3.17%, which is a pretty good valuation. Obviously, that would require them to put up 70 million, which, I mean, if we look at this, 70 million is doesn't seem like a lot. Their Q4 kind of always seems like their biggest one. I mean, last year it was. So, I mean, if they put up 70 million, we'll see. Maybe it becomes a bit of a no-brainer. Okay, so the second stock that I'm maybe looking to pick up this month is Microsoft. It's traded sideways this year when most of the other Mag 7 has gone up or seen some returns. I mean, it has made returns at some points, but it seems to have gone sideways for at least the last year. I've got a price alert at 390, which is sort of when I'm really sort of getting interested in it. If I like to have a look at the PE over time, you can sort of see actually that it's actually a little bit high compared to 2021. 2022 is obviously quite a good time to buy. But yeah, it has come down over this year, maybe unjustifiably. Investors are obviously a bit concerned of the investment they're making into growing their AI infrastructure. They're trying to justify it by saying, we've got a backlog of customers, we're turning people away, kind of thing, for the data center and the rest of it. So, but I've always wanted to own some Microsoft, so that's why it's in here. I'm not going to do too much analysis on it because it's such a well-covered business that I don't feel like I can really add much insight to this one. Okay, so the third and final business I'd like to look at today is a company called Toast. This is a company that trades on the New York Stock Exchange, and it specializes in point-of-sale software for restaurants. As you can see, not great viewing earnings per share wise until last report, which was when was the last report actually? I can't remember. I'll look it up in a minute. But as you can see, this thing is growing revenue at 28% CAGR, similar to Sports Radar, which was 27%. Sorry, and it needs to because the valuation is super high right now. So it's just had an earnings report this week, and it's trading down 7.3%, which I think is a good opportunity to buy this one. It's currently at 1,000 PE ratio, but obviously if it's growing revenue 30% a year, this is gonna come down quite quickly. So if we have a look at the PE again, you can see, that is not pretty looking. It's off the chart. Yeah, I mean, valuation-wise, it doesn't look like a great business. Even Alpha Spread thinks it's overvalued considerably based on its discounted cash flow. But if we go down here, you can see, I mean, the revenue is up and to the right, growing quickly. Net income, exactly the same, has gone from negative to positive recently. Literally for one quarter. So this one is really, if you're buying this now, you're sort of getting in as it turns potentially. As you can see here, December 2023, free cash flow positive, and it has been growing ever since, 229% year over year, which is huge. So if we have a look at the report, so in the recent business highlights section, I think this is really interesting down here. They've announced partnerships with Uber, and they've also started working with some big chains, James Beard, and work with over half of the Michelin-rated US restaurants, which it shows the quality of the business. I'm pretty sure Michelin-star restaurants don't sort of dabble with new technology if they can help it. The restaurant industry probably is quite old school and moves slowly to make sure that quality stays high. And also they're breaking into hotel chains potentially, which obviously has huge numbers for Toast, which is amazing. But if we have a look back at the free cash flow, which is here, you can see it is putting up good numbers every quarter. Gross margin is a little bit low. It's obviously it's quite early in its inception. But hopefully we can see see this one put up some good numbers, and potentially if I buy this one this month, looking forward, it can keep growing that free cash flow and sort of justify its PE ratio, and we can see some good return. And that gives us a free cash flow yield currently on 306 million, and 200 billion, 20 billion, which I think is the market cap, 20.66. That gives us a free cash flow yield of 1.53%. So when you compare that to Sports Radar Group, which has also put up good numbers, is growing really quickly, and that's valued currently at above 3%, if all ends well with their Q4. So I think I've done what I intended to do for this video, which was to sort of just air some of my thoughts. I've got one relatively well covered and safe stock, which is Microsoft. I feel like anyone could put money in Microsoft, and over the long term, which is my horizon, over the long term I'll be confident Microsoft would make a return. Sports Radar Group, obviously it's a bit of a different one. It's quite a small company relatively, and it's not well covered is what I mean by that. And then Toast is obviously a very young up and coming stock, which I think will become quite well covered, just because of its sort of turnaround this year. But I'll be interested to know your thoughts down below on these three stocks. Obviously, the fourth option is that I invest in companies that I'm already invested in, sort of to bring my cost basis down on most of them. But something like a Google would be a great investment right now. ASML, I'm kind of okay with where it's at. Booking, I'm okay. I could invest more in MasterCard, and then sort of Salesforce. Salesforce has got earnings coming up, so that'd be an interesting one to watch. But yeah, these are all good options, and let me know which one of the three, or all three maybe, you think I should add to this portfolio. Thanks for watching. If you made it this far, don't forget to like, comment and subscribe, and I'll see you again for a portfolio update soon.